Welcome to Econoday Unplugged. Today is the last day of July, Tuesday, July 31st. I am Ann Picker, Econoday's chief economist, and with me today are Jeremy Hawkins in London and Mark Pender in the U.S. Before Mark preps us on the FOMC announcement that will be given on Wednesday and employment on Friday, and Jeremy gives us a brief survey of his overload of important economic data, along with the Bank of England, we should catch up with the Bank of Japan, which issued its policy statement very early U.S. time today. After 10 days of conjecture from when the first rumors of possible change in BoJ policy surfaced, the bank has once again vowed to maintain, quote, extremely low interest rates and revealed a series of tiny adjustments to policy, quashing 10 days of speculation that it was mulling bigger changes to its policy framework. Seems to me that was analyst wishful thinking. After being forced 3 times in a week to intervene to cap bond yields, the Bank of Japan ended its 2-day policy meeting with a declaration that it was strengthening the framework for continuous, powerful monetary easing. The bank held its benchmark interest rate steady at minus 0.1%, but introduced forward guidance on policy rates and said it would permit greater movement of the yield on 10-year Japanese government bonds, that is JGBs, as well as allocate more of its ETF purchases to those that track the TOPIX index rather than the Nikkei. The yen dropped in value while the TOPIX briefly erased its morning losses to trade flat before its sinking 0.8% on the day. Meanwhile, the yield on 10-year Japanese government bonds fell 4 basis points to 0.5%. The BoJ had been forced to intervene in the bond market for the third time in the space of a week Monday after the yield climbed to 0.11%, its highest rate since February 2017. The changes announced involved efforts to make the BoJ's massive stimulus program more flexible. The bank repeated its pledge to continue to purchase bonds so that 10-year JGB yields would remain around 0%, but added the line that the yields may move upward and downward to some extent. Analysts, however, said that the flexibility in bond operations was already implied by the around zero commitment, and the new line did not imply the expanded trading range that some markets participants had been expecting. The BoJ also introduced forward guidance for policy rates, saying that extremely low levels will remain in place for an extended period of time due to uncertainties linked to the planned consumption tax increase in October 2019. In line with the expectations, the BoJ said it would alter the balance of its per-year ETF buying program so that a greater proportion was focused on that track of the broader market cap weighted topics. Mark, get us ready for tomorrow.
Well, actually, I have a question, Ian, about the BoJ. It kind of baffles me. I mean, this has been their super aggressive monetary easing. It's been going on for 20 years. And it doesn't seem to vary very much. Is this a permanent? How long is this? Just a permanent situation?
Permanent? Well, if you go back and look at how long it's been at negative zero, it's been a few years. You really have to go back far to find any substantive interest rate for Japanese bonds.
Uh-huh.
They've
Well,
really been under. I thought I had the graph pulled up, but it's obviously gone away somewhere.
do they ever lose heart, or do they ever think that they should shift policy? Is this policy adequate? I mean, it always seems to be a repeat.
Well, they're firmly in belief that long enough this policy will succeed. The CPI in June was on the year up 0.7%, slightly below their 2%, to say the least, inflation target. However, it's better than the zero that it had been. So you can take it from there.
Okay, well, I will. There is more variation, with the Federal Reserve. We're going to be getting their meeting today, Tuesday, and tomorrow will be their statement. There is outside expectations in Econoday's sample for a rate hike. This would be, politically, it would be an assertion of independence, which it's hard to miss a chance to do that. But it also would follow last week's 4.1% jump in GDP. And the Federal Reserve is in the business of monitoring risks and reducing them as much as they can. And capacity stress is definitely a risk right now. We're seeing it in the different reports, price pressures at the producer level. We also had a little bit of an uptick this morning in consumer inflation expectations, which is very unusual. It hasn't really shown life, and it's been moving up since April. So there's a little pressure there. Still, there's really no chance, really, or very, very little chance that the Fed will surprise anybody tomorrow. It's just a statement. There'll be no forecast, and there'll be no press conference. So it's probably going to have a little bit of a hawkish edge. Even though this morning we had mild readings in inflation on the core PCE price index, which is their main inflation gauge. Very little movement there, just right around the 2%, not moving higher over the 2% line, but holding right about there, which is pretty much where they would want it. But it's, of course, the risk of that the employment labor market is so strong that there is the risk, of course, of inflation. And even though we really haven't seen it to a great degree, it's still there. And in any case, we're probably, like I said, we're going to get a hawkish edge to a statement tomorrow. Certainly the employment report on Friday will be, the expectations are very strong. All the indications going into this report, jobless claims, we had today's consumer confidence report, we had jobs hard to get. People say that's very, very low. Jobs, and that's a very positive indication for the employment, for the labor market. The Econoday consensus for Friday's non-farm payroll is 190,000. That would be very, very solid. And a little bit, another tenth lower in the unemployment rate to 3.9%. Now, let's not forget the unemployment rate popped up to 4% in June, but that was due to discouraged workers returning to the workforce. And what I mean by returning to the workforce is that they're pounding the pavement looking for a job that gets them into the labor force statistics. And earnings are a little bit of pressure is seen in the monthly. Econoday's consensus is looking for a 0.3% monthly rise, which is a little bit noticeable, although the year-on-year rate isn't expected to move from 2.7%. It's been a very, very, very busy week so far of economic data. It's going to be a very busy week going right through. And if everything kind of hits expectations, we'll be looking again at improving growth centered in the factory sector, not including the housing sector, with price pressures still being contained below the consumer level, probably looking for 2 more rate hikes before the year is out.
Thanks, Mark. Jeremy?
Okay, well, I suppose just first comment is the knock-on effects from the BoJ decision. I think, if nothing else, European bond markets have taken the announcement, which they're still digesting relatively positively, in the sense that Japanese buyers have been extremely important for the Eurozone bond market, particularly the French bond market. So the fact it still looks as if we're going to have these low yields in Japan, that's got to be at least relatively good news for Eurozone bonds. More domestically focused, though, as folks probably saw, last week's ECB meeting was notable for just about nothing, bar the fact that the president, Draghi, sounded that much more confident about underlying inflation picking up later in the year, and also still seems very happy with the idea that the first quarter economy slowdown would just be temporary. Now, this is a bumper week for European data, which really gives us an opportunity to see just whether or not the ECB got it right. And we've already had three of the most important reports, and as far as that's concerned, I suppose really ECB wise it's been both good and bad. The good news is that the flash July inflation figure came in, the headline at 2.1%. That was up from 2% last time. And more importantly, the core rate, that was up at 1.1% from 0.9. So the ECB is going to be happy about that. But, and of course, there's always a but with inflation in the Eurozone. The latest core only reversed the fall we saw coming through in June, and it's still within what has been an extremely tight range over the last year or so. In fact, even now it's below where it actually was in July 2017. So, in other words, there's been no real change in trend, which remains as flat as ever. Not so positively for the ECB, and it's something we talked about before, needs to be kept an eye on, I think, because the GDP figures, we had the so-called preliminary flash second quarter GDP data. That showed a straightforward quarter-on-quarter increase in total output of 0.3%. So annualized it US style, that would be 1.2%. Now that was down from the first quarter, and indeed it equals the weakest performance we've seen by the Eurozone economy since the second quarter of 2014. So while developments US side may be booming, on the Eurozone side it appears to still be slowing. And of course, this is in contrast to the ECB's contention that the first quarter slowdown was just supposed to be temporary. Also, from what we've seen from the flash PMIs for July and the economic sentiment index for July, that was released earlier on this week. It's a very good snapshot of what's going on in the economy generally, and also has a good correlation with Eurozone GDP. That produced its seventh consecutive decline and its weakest reading since last August. So if you kind of put a straight line through that little lot, it doesn't look as if the Eurozone economy is quite living up to what the ECB thinks it's going to do. Now, we don't have the German GDP numbers yet, but France, that saw just a 0.2% quarter-on-quarter increase in GDP. Italy was only 0.2. That's its weakest since the second quarter of 2016. Even Spain, which has been helping to hold up Eurozone growth, that saw a decent enough 0.6% quarter-on-quarter increase in GDP. But again, that was its weakest since the second quarter of 2014. So in other words, it remains really a question mark as to whether or not the Eurozone economy is still slowing down or whether it's bottom. But if it does continue to slow, then clearly it's going to raise at least some doubts about the ECB ending its quantitative easing program at the end of this year. Thursday, we get the Bank of England meeting this week, and this is going to be a really interesting one because I think it is almost a 50-50 split in the market now as to whether or not we'll see another hike in interest rates. On balance, it's probably just about the case that the market's anticipating a 25 basis point hike in bank rate, which should put it up to 0.75%. We won't see any change in quantitative easing until interest rates are a lot higher. So the numbers have been quite mixed, but it's going to make it an interesting call, and market should react almost to whatever comes out as the final result. Also, just quickly mention for people who like looking at the details of the economics, we'll be getting an update on the Monetary Policy Committee's thoughts on R-star. Now, that's the real equilibrium level of interest rates that keeps the economy growing at its full potential while keeping inflation on target. Now, it's really a long run thing to be worried about. But if we know what R star is and we know what the inflation is supposed to be, which is 2%, that's its target rate, then we can work out the appropriate level for bank rate. So if the bank comes out and suggests that R star should be 1%, then inflation rate is supposed to be 2% plus 1% gives you 3%. And that will give a kind of a target rate for financial markets to think about for bank rate further down the road. If the Bank of England suggests it could be minus 1%, then that would suggest that bank rate really should top out at 1%, which is just 50 basis points from where we are now. So it's something just to bear in mind, because markets, particularly the longer end of the yield curve and things like that, will be taking note of it to try and get a feel about, well, if interest rates are going to go up, how high they're going to go.
Jeremy, I have a question on the UK.
Yep.
The upward bias now for rate hikes. Now, is that tied to economic strength in the UK, or is that a currency issue, importing inflation? How should we look at that?
Well, good question. I think the bottom line has got to be it's due to supposed economic strength, because if it's a currency issue, then, playing around with interest rates suggests you've got an exchange rate target. We don't have one of those. But if you look at the economic numbers, it's really been a mixed bag. And we had weakness in retail sales. They fell in June. June inflation was unexpectedly weak. Wages growth is still flatlining. So you really have to look at some of the new monthly figures on GDP, which were surprisingly strong for May. And indeed, the labour market is still tightening. But it really leaves it as, in kind of the case, if you didn't think interest rates should go up at the last meeting, what's really changed to make them go that way? And if you thought interest rates should have gone up at the last meeting, and you're probably still going to vote that way anyway. So at the last meeting, it was a 6-3 vote for no change. It wouldn't surprise me if we actually came down to Mark Carney's casting vote on Thursday to decide what's going to happen. It really is a very tight call. But I think what we can say is that the bank wants, to try and normalise policy with a view to Brexit coming up. If we get a hard Brexit, the bank's already described that as being a potential major shock to the UK economy, and it's going to want some ammunition from the monetary policy side to help it. And of course, we've got interest rates at 0.5 percentage point. There's not a lot of cuts there left.
So they just need to get it up for their own. So they have elbow room, but exactly it's not a question, immediate question, or a change in the outlook for inflation.
Not really, no. If anything, we were surprised with the latest set of inflation figures, which actually saw the core rate dipping below the 2% target. So if you just take the latest price numbers, they've actually been very positive for those people calling for no change in interest rates. I think it's much more to do with the fact that the bank really would like to see some form of normalisation of policy sooner rather than later.
Thanks, guys. Until next week.